The US dollar index has surged this morning, up over 0.9% intraday as buying pressure pushes it above the 109 level for the first time in 2 decades. Yesterday, the Bureau of Labor Statistics revealed that month-over-month CPI in June clocked in at 1.3%, whereas 1.1% had been expected. This means that year-over-year, inflation has hit 9.1% in the United States, identical to that of the United Kingdom, tied for highest among the G7 countries. Likewise, even core CPI, which excludes volatile food and energy prices, reached 0.7% month over month in the US, whereas only 0.5% had been anticipated. This is extremely bullish for the US dollar and reflects as such among the major pairs. In fact, it has even prompted the euro-dollar pair to briefly plunge below parity support today, testing the 0.995 level for the first time in 20 years. While it would be easy to pin this momentum entirely on demand for the US dollar, in terms of fundamentals, the story is even more bearish for the pair than the new numbers indicate. Let's juxtapose these two currency circumstances as we engage in a newly revived discussion, the significance of which is huge, making sense of the euro-dollar parity. US dollar strength factor number 1. Holistic hyperinflation. The US economy continues to overheat as sustained inflation accelerates. This may seem trivial considering how ubiquitous this phenomenon is. After all, even if the US is tied for the highest inflation in the G7, aren't the country's inflation rates comparable enough and their supply chains mutually globalized enough that the exact numerical differences would be irrelevant? However, when we sift through the details, inflation in the US is particularly robust and nuanced. In spite of this slight uptick in unemployment claims, the American labor market remains especially hot. High NFP numbers, a historically low 3.6% unemployment rate, and millions of unfulfilled job openings signal economic vitality, feeding strong demand. Likewise, U.S. monthly good trade deficits are hitting record numbers, consecutively surpassing $100 billion despite the U.S. dollar's high value relative to other currencies. Even core CPI is beating market forecasts by big margins. These all signal strong U.S. consumer spending that will continue into the near future, feeding inflation. U.S. dollar strength factor number 2, a hawkish Federal Reserve. The Federal Reserve, the United States Central Bank, has come a long way from the dovish institution that was dishing out monetary stimulus throughout the pandemic. Gone are quantitative easing and near zero interest rates, replaced by quantitative tightening and steadily growing rate hikes. The Federal Open Market Committee, the policymaking branch of the Federal Reserve, last implemented a rare 75 basis point rate hike in June, with Chairman Jerome Powell signaling more aggression to come on a case-by-case basis depending on the severity of inflation.
If you're an aspiring technical analysis trader, we have a special gift for you. Right now, we're handing out copies of our technical analysis course 100% free. In the comment section below, you'll see a link to one of our team's Telegram chats. If you send us the message Technical Analysis Course, we'll send you a copy totally free. This is a special thanks for supporting our content. Now back to the video.
Considering that inflation in the US continues to surpass market predictions, if FOMC dispositions and Powell's warning are true, US dollar seems primed for further bullishness. Euro weakness factor number 1, acute energy dependence. While the European Union is likewise contending with hyperinflation concerns for many of the same reasons as the US, certain underlying economic conditions exacerbating the Eurozone inflation are particularly worrisome. For example, much of their energy supply is contingent upon oil and gas imports from Russia, which they now have limited access to due to economic sanctions. For example, a partial embargo on Russian oil and open potential for retaliation. In 2021, Russia supplied more than 25% of the European Union's crude oil imports and approximately 45% of the European Union's natural gas imports. By contrast, Russia supplied only 8% of all US imported oil. This chronic dependence enabled the European economy to endure a relatively underdeveloped energy sector, while consequences from the invasion of Ukraine strained the trade partnership with Russia. This variable makes Eurozone inflation particularly devastating because of the degree to which it is caused by severely restricted supply, not merely too much consumer demand. Combined with myriad other war-related risks, this is quite bearish for the euro. Euro weakness factor number 2, a timid European central bank. The European Central Bank has been hesitant to fully commit to the pivot towards hawkishness, although they are gradually phasing out expansionary monetary policy via 25 basis point rate hikes, which is significant considering that negative interest rates were precedent pre-COVID. They lag far behind their foreign central bank counterparts in terms of aggression, despite 8.6% year-over-year inflation. This caution may be for a variety of reasons, including stagflation worries related to the unsettling 6.6% unemployment rate, as well as economic advantages that come with the depreciating euro, potentially boosting European exports. Regardless, the European Central Bank is walking, not running, towards a newfound hawkishness. Will Euro-USD parity become the new normal? Regarding long-term valuation, it is impossible to say for certain whether Euro-USD parity will become a guiding principle. However, due to the aforementioned fundamentals and differing trade advantages, there is a chance that the euro's value exceeding that of the US dollar by the margins of the last few decades could be a thing of the past, at least for a while. Considering the extent to which the global economy has been rattled, the disparity between the Fed and the European Central Bank's trajectory of monetary policy decisions, it even seems plausible that Euro-USD could experience a full breakdown to the downside of parity to support, discovering more selling pressure. Some key takeaways. According to newly released CPI numbers for June, month-over-month inflation hit an unexpected 1.3% or 9.1% year-over-year in the US. This has caused demand for the US dollar to soar, even dipping Euro-USD generously below parity for the first time in 20 years. A substantial component of US dollar strength is how holistic US inflation is. While supply chain issues are affecting US markets in a similar manner to other countries, a hot labor market, historic trade deficits, and rising core CPI affirm resilient consumer demand. Another integral factor promoting US dollar strength is how hawkish the Federal Reserve has been in recent months. Considering the severity of their recent rate hikes and how sustained inflation continues to accelerate, more tightening likely lies ahead. A critical problem exacerbating euro weakness is the European Union's significant lack of more localized energy supply. An acute reliance on importing Russian oil and gas has left them vulnerable to their own sanctions and any potential retaliation, limiting euro bullishness. Another issue facing the Eurozone is the European Central Bank's wariness of full-blown hawkishness. While they have pivoted in a sense, implementing a rate hike and departing from negative interest rates soon, they lag far behind many of their foreign counterparts. Euro-USD parity could become a new precedent long-term, especially considering the Eurozone economy favors a cheap euro for increased exports, and a strong US dollar means cheap imports for the US. It currently seems probable that the pair will sink even lower.